welcome. You're watching Business Today Television. I'm Sakshi Batra and this is Market Today, a show where we'll help you understand the opening action, the trading setup and the market strategies you need to follow for the day today. Now, Indian equity markets resuming trade today after a midweek holiday on the occasion of Ganesh Chaturthi, and the trading resumes on monthly expiry session of the Nifty 50 contracts. Remember, the index is walking into this expiry session after a sharp sell-off we saw on Tuesday when the Nifty closed at a 3-month low. Now, the index has also given up all the gains that it had gathered in the August series thus far. Now, remember, today is also an important day because the markets will be reacting to Donald Trump's additional 25% tariffs on Indian exports to the US, which have taken effect from Wednesday morning. Now, on Wednesday, how are the US markets trading? Well, the S&P 500 index and the tech-heavy Nasdaq index, they closed higher, 0.2% higher for both these indices respectively. Now, although we've seen the future contracts this morning for the US markets starting to drop a little bit, that's after we've seen Nvidia Corp sales outlook has fallen short of high expectations, and therefore there is some weakness on the future shares. But definitely on Wall Street, overnight trade was definitely positive. Now, as far as this morning trade is concerned, most equity benchmarks in Asia trading higher as well. Even though Wall Street stocks did pair off gains after hitting record high levels on Wednesday. Japan's Nikkei is up by about 0.3% higher in trade, now 0.5% up is what we are given to understand. China index is also up 0.5%, even though Hang Seng is down by 0.6%. Kospi is up by about 0.5%, even though GIFT Nifty is indicating to a negative start in trade today, now down by about 70 odd points at 24,664 is what we are given to understand. Remember, this is as a reaction to the tariff blow of 50% that lands hardest on some of the low margin and high labor intensive industries in India, namely apparels, textiles, auto parts, engineering goods, gems and jewelry, shrimp and even carpets kind of industries as well. There are industry bodies, trade bodies that are already coming out and talking about how this blow will not be able to sustain the exports that are ongoing with the US, at least at this tariff rate. We've also seen the Global Trade Research Initiative, the GTRI, talking about how these are the sectors that will be hit the hardest, and there is a potential loss of over $80 billion of trade that we were doing with the US, now coming down to under $50 billion as well. Now, apart from this, watch out for even Nifty Bank as the exposure of the lenders to these tariff-hit sectors like textiles, gems, seafood could also create further asset quality worries for the banking sector at large as well. So that will be also our key point of discussion. Let's now welcome our guest on board, Mr. Devin Choksi, the MD of DR Choksi FinServ, is now joining in on the program with us. Warm welcome to you, sir. Thank you so much for taking the time out. Important day of trade, and this is when we will want to seek your guidance when it comes to trading and making our fresh investment strategies in this new world order when we have been hit the hardest in the world with a 50% tariff on India by the US.
Yes, actually, good morning. Well, I think tariff may be one of the reasons for market to cool down. But I believe that I think this is a period where probably we are going to get a significant amount of opportunity from investment perspective. This uncertainty definitely, I think, is a painful uncertainty. Certain industries which are labor intensive, which are likely to see a major shift as far as I think the business is concerned. They may probably be struggling to export, I think, their goods and services, I think, to some other countries vis-a-vis the direct export to America. They may be incurring a relative amount of uncertainty related cost, I think, onto the subject, etc. So it's a painful process. But in my viewpoint, I think the good stocks, when they come down due to this uncertainty factor, they give you an opportunity. And I believe that I think this next 1 month time, 30 days time from now, is going to be the time in which probably we are likely to see the market making an attempt to correct itself, I think, from its previous low. I think it will try and correct itself further. So if it is so, then in such situation, it's a buy opportunity. Not completely sure how much fall we are expecting in the market, but as of now, Nifty at 24,200 levels is a decent level to field for. Should it break, then probably I think we'll have the further opportunity coming up between 23,000 to 24,000 levels. I think in that range, probably we might see the opportunity coming up.
Okay, so the market could test about 24,200 kind of levels, but below that, there will be another view that we will have to take. But you did say that it may be a buying opportunity in the near term if these kind of levels come in. Would there be a buying opportunity even in these export-oriented sectors like textiles and apparels, also gems and jewelry? Do you think this is going to be giving an opportunity there? Do you also believe, sir, because the industry has been wide asking, and I think the government is also constantly talking about that the government will handhold these sectors in case of losses on that front. So, do you also expect some subsidy to come in, sir?
I would think so. Maybe some part of the relaxation by the government, some part of relaxation by the banks, uh, possibility of these companies exporting their, particularly in gems and jewelry business. They may be exporting to some other countries. I think that is distinctly possible. Plus, there are certain amount of loose ends in this entire arrangement, particularly in the jewelry segment. If you import the casting from America, fit the gems into it, and then re-export thereafter, then there is no duty structure. So, quite possible that such kind of gaps in the policy could possibly allow some of these companies to continue their business. Maybe logistic part would be slightly painful. Maybe I think the cost incurred on those logistics would be slightly more higher. But as I see it, I think the business will continue, maybe at a little smaller pace or slower pace, as one would like to call it as. Textile definitely, I think, is one which is going to be watched out for. But I would guess, I think the larger interest of America, probably I think this tariff business is not likely to continue beyond certain period. Because of the fact that I think if their own consumers are not going to get the products which they want before the festive season in Christmas, I think that there is going to be a boomerang in their economy. So mindful of that situation, quite possible that I think the situation may not last. But yes, I think till that point of time, there is going to be an interim pain, as we would like to call it as.
Okay, so there's also this expectation that there will be a lot of impact on the broader economy because of this. Even the finance ministry has come out with the statements that while the tariff themselves may have a limited impact, the secondary and the tertiary kind of an impact should be watched out for. What exactly will be the impact on, say, employment, job losses? Will there be any? Because, like you also pointed out, these are labor-intensive sectors, and once the export lines get either minimized or shut completely, the impact will be felt on those employees. And apart from that, on the overall impact on the GDP as well. How are you looking at that?
Fortunately, India has also signed the FTAs with other European nations. Among them, I think also would include some of the nations like Australia as well. So, quite possible that our goods and services, particularly in the textile segment in which we are talking about, could be routed through Europe. And more than us, I think it's going to be affecting the consumers in America because they'll be paying higher price for this kind of inefficient logistic management activity which will happen eventually. Demand do not die, but at the same time, I think if the cost remains higher, the consumer bleeds. And that's what I guess I think is going to be a situation in America. So maybe that's why I'm of the view that I think it's not going to be a long-term tariff business. I think it's going to be a short-term pressure tactics, as we call it as. Let's wait and see. But in yes, I think in the interim period, I do agree that untoward situation results into some kind of complicated tertiary impact, as you mentioned. I think this is not ruled out. So let's wait and see how exactly it reaches out to the far off segments, I think, within the mainstream of industry.
Okay, so the Nifty is in fact indicating a higher start, over 200 points up at 24,954. Let's see how this settles. About few minutes ago, but this is definitely giving a breath of positive reaction to the markets as well, despite being hit by a 50% tariff. Let's see how it settles down about a few minutes from now. But Devin sir, like you pointed out, that there will be some opportunities on lower levels for investors to look at. If you could detail for us top 2 or 3 sectors that you believe this knee-jerk reaction should be taken benefit of for our investors.
The auto ancillary remains relatively more stable. I find that I think this is one area where the tariff clarity, particularly with European nation, is definitely working well. Mind well, Mexico and Canada, I think they are the two countries where we have the ability to route our export through those countries. So certainly, I think some of the industries, particularly in the auto ancillaries, I think the business environment would remain relatively better as I see. Uh, Domestically, running businesses which are connected to the infrastructure, power and power utilities included, I think they are likely to see the better business environment also because of the fact that government orders are coming in and they are being executed. So certainly, I think the sectors connected to it, including the manufacturing, could possibly be the ones I think who are likely to see the relatively better performance in continuity. Uh, in some of the IT companies where probably the requirement is to provide the services on a B2B basis is the one I think where probably you might see a continuity in the business and this kind of correction in the price could give an opportunity. So yes, I think instead of generalizing, maybe I think companies within these sectors would remain pretty sure they are growing. Consumers and consumer durables, discretionary, non-discretionary consumption continuing in the country and growing is definitely I think a good sign, and that's also the reason for which we remain slightly more bullish on the auto and auto ancillary, apart from select real estate companies.
Okay. Let me also ask you on the banks, sir. What we are given to understand is that banks always have higher exposure to such sectors that are export-oriented sectors as well. Will they also face certain asset quality concerns, and will they have to provide for more of such cases over the next few months? How would you look at banks?
If the problem related to tariff, I think continues for a longer period of time, yes, I think you are going to see a challenge. But if that particular problem is not lasting for a longer period of time, then might well, I think this particular storm will pass through. So I would like to believe that the problem is not going to last longer as far as tariff is concerned. And so the banks are not going to be adversely affected beyond the point. I would like to believe that. But let's wait and see. I think if it is not so simple, might as well, I think some amount of time we'll have to allow it to go through and then see how exactly the impact is coming in. But as of now, we are not very negative on the banking sector per se because they are carefully handling their advances to their customers.
Fair point. So there are some sectors that are exempt, either exempt from this immediate 50% blow, or they are governed under some separate tariffs. Like for Indian pharma industry, that's still exempt from an intermediate tariff. Semiconductors, consumer durables, also covered by a separate sector-specific US tariffs. Aluminium, steel, also governed by a separate tariff. How do you look at all of these as of now?
In fact, I think playing devil's advocate here, I think if the US government wants to increase the tariff on this sector which you mentioned, they should do it immediately because I think that will probably, I think, unsettle the president
Yes.
in USA immediately. See, this is not going to be easy affair for any country to absorb. If your customer is used to buying Apple iPhone at $1,000 and if you are asking him to buy at $1,500, your presidency is going to be threatened. If your pharmacy bill of month is say $100 and if you are required to pay 150 to $180, I think your presidency is going to be in question. So frankly speaking, I think if they want to do it, I think they should do it immediately on these sectors so that at least I think this pain goes out faster.
Okay, fair point. What about the Indian IT sector, sir? How are you looking at that one? We've seen muted earnings come by in Q1 for sure. The stocks and sector have largely been in underperforming zone over the last couple of months. Do you think this weakness has given an opportunity to relook at the IT sector since services are not tariff, but of course there could be an indirect impact. But at least for now, how should one look at the IT sector?
I think one of the best thing that one can experience today, I think learning from TCS, Infosys, among others, they are actually, I think, training their entire business model to the AI way of execution. And that is giving me a distinctly high amount of confidence that yes, it may not happen like a switch on, switch off kind of a situation, but the fact remains that if they're adapting to the new way of execution, then probably I think the customer out there is going to be more than happy because today the customer is now willing to pay to the company on outcome basis as against I think the time and value basis which they used to pay earlier. So certainly I think if the Indian IT companies are producing the outcome based solution for their customers, the business would start coming into them very fast. And that's where probably I think we should see the better times for them. I would like to believe that I think the downside in the IT for stocks at this point of time is probably very limited. Maybe the upside will take a gradual course, but I believe
Yeah.
that I think there's possibility.
Okay. So we have also, set our foot in the festive season now with Ganesh Chaturthi. Wanted to just ask you, this also coincides with our own domestic policy changes with respect to GST at large. The big question I think everybody wants to know is how much of a cushion can the GST changes or rationalization provide against this tariff blow that we are seeing as of now? Should one now concentrate their focus on the newer rates that will be announced in the first week of September? What could that lead to in the ongoing festive season, especially the Diwali, the Shera season, because that will be the first month to see the impact of the newer GST rates, sir?
So I think I would like to first give the compliment to the government and the Prime Minister for thinking proactive. I believe that when there is a crisis situation happening in the global front, at that point of time, if you open up the domestic front in favor of the consumer, I believe that I think the business conditions emerges very, very strong. This is a time when probably with the reduction in the GST rates could have the multiplier effect also. Because on one side, when you see this product prices falling, automatically I think some amount of pent-up demand always I think arises. At the same time, as we have always been calculating, that the tax exemption limit having increased it to 12 lakhs, I believe that I think leaving more money in the hands of consumer, the consumer will be spending more. And last but not the least, I think with the reduction in the interest rate further coming in going forward, I believe that I think the amount of spending will increase. And whatever the revenue loss that the government may have due to the fall in the tariff of GST, I believe that will be more than paid off by way of a higher amount of consumption which will happen in the economy. So I remain cautiously optimistic on the prospects going forward and believe that some of the companies in the industries I think are likely to see relatively better performance in coming 12 to 18 months.
Fair point. All right, Devinsa, thank you so much for being with us then on the
Thank you.
program and helping us with all your insights on these various moving parts that we have to constantly monitor over the next few days as well. We'll get you soon, to talk about once some more clarity emerges from here on as well. Thank you so much for being with us.
Yeah, thank you so much.
All right, viewers, the markets have settled tad lower in the pre-open trade. 24,695 is what the Nifty is currently trading at, 0.07% lower. You can see the autos, FMCG, oil and gas sectors indicating a positive start, whereas banks, IT and the broader markets could be starting on the back foot. But like we were talking about the GST, changes that could be brought in sooner. Remember, the 56th GST Council will convene on now 2 days. That's 4th of September, 3rd and 4th of September in New Delhi. Now, a host of products will definitely see tax changes. And as per sources to Business Today Television, there could be many that could actually give you a breath of relief because of lower taxation now. Let me invite my colleague Karishma Sudani, who's been at the GST story right from the very start, getting us all those breaking coverage as well. Karishma, good morning to you. On market holiday yesterday, you were speaking to your sources and you got us a slew of data points as to what can we expect. So, those are the two important dates that we are watching out for, 3rd September and 4th September. Of course, 2 slab rationalization is what we are given to understand so far that could come in. Help us understand more. What could be cheaper?
Sakshi, we are picking up from our sources that a lot of products which are in the 12% or the 18% slab will likely move to the 5% slab. So common household items like that is, say, butter, ghee, condensed milk, cheese, cereals, which a lot of people actually enjoy on the go, while I completely don't advocate it as a healthy food option. It's an on the go breakfast that a lot of people enjoy, and that's also going to come down to 5%. I'm also picking up from my sources that some kind of nuts, especially the Brazilian nuts, dates, dry fruits, those trial mix packs, all of them are going to see a major reduction in the cost. Pastries, chocolates, cookies, cocoa butter, in fact, and any of the product that has cocoa butter in it will also see a major drop in the taxation from 18% to that of 5%. Now, many other household items government center has decided should be charged minimum. This is so that consumers can enjoy the maximum benefit out of paying as less as possible. And this benefit actually goes to the consumers and not just stays in between the industries.
Absolutely. So, Karishma, tell us what's going to be expensive. I hear that electric vehicles are going to be in for a surprise. There could be higher rates on EVs.
Yes, in fact, when I was speaking to my sources, they did share that the states are of the opinion that the center should look at charging some goods on a higher note. Now, high-end electric vehicles is one such proposal that the GOM has been submitting since their last three meetings. It is post the Jaisalmer meeting, that is the 55th GST Council meeting. The GOM, the state panels had summarized a proposal which meant that 18% GST should be on high-end electric vehicles, the ones that cost the 20 lakh bar, and a higher rate above the ones that will cost a 40 lakh, will be above 40 lakh. So I'm told by my sources that the states, especially two opposition states, will be raising this in the GST Council meeting. And Sakshi, this is going to be big at a time where Tesla is wanting to make such inroads in the country.
Absolutely. Shell out more then. I think the best time to buy EVs was yesterday, if not before 3rd of September for anybody who's looking at that then. Okay, lastly, help us understand, what about the sin goods? How are they likely to be taxed, Karishma?
Yes, so sources tell me that the GOM on rate rationalization, which is again yet another states panel headed by Deputy Chief Minister of Bihar, Samrat Chaudhary, they have submitted a proposal in consensus that the sin goods should receive a special rate. This is going to be a 40% special rate on demerit goods like that of cigarettes, tobacco, pan masala, and in fact, some luxury goods could also have this kind of special rate of 40%. The idea is that, of course, states need to think not just about passing on the benefit to consumers by imposing lower tax, but also filling the revenue gap that is going to come majorly. And we are looking at about close to 10,000 crore revenue gap that states could suffer on making these changes. I think a very important decision will be on compensation cess that the government will take. Our sources
Yes.
have told us that there could be an additional levy in place of compensation cess that the center could introduce, and this could go on luxury or sin goods.
Perfect. Karishma, be at it and get, keep getting us all those updates, because this is going to be big and will be the most important GST Council meeting that we will all track, in the last many years then. Thank you so much for getting us all of those updates, and thanks for those exclusives. Looking forward to final prints on the same as well. 9:15 viewers, let's get started on the markets then. 24,657. We've started on the back foot, about 60 points lower in trade. There's a 0.25% of a drop on the Nifty. In case you want to look at the sectors, autos are driving up positive on this weak sentiment kind of a space. A 0.25% up for autos. FMCG also on a higher note. You can also see some gains on oil and gas, but rest of the sectors have all slipped. Real estate, IT, consumer durables, metals, for instance, broader markets, they've started on the back foot on this day. Now let's look at the top stocks on the Nifty. Hero is the top mover, 1.5% higher. You have HUL that's also moving up in tandem. Eternal, Maruti Suzuki again from the auto pack, that's also hovering higher. Eicher is up. Axis Bank, Adani Ports, these are some of the gainers in trade right now. What started on the back foot on the Nifty today? Shriram Finance, HCL Technologies, HDFC Bank. These are the clear stocks that are starting on the back foot. So banking names, IT names, now seeing some profits being taken off. What's doing well in the F&O space? Avenue Supermarts, 1.5% higher. Look at UPL, Hero Motocorp, TVS Motor, all of these stocks that are hovering over percent higher as far as the F&O action is concerned. But look at Indigo. That's the stock to watch out for right now. There's an 88.6 lakh shares that the deal is done. 3.9% lower in trade at 5,810 is what you're looking at Indigo on. About a 4% drop right at the open of the trade. And that's as a result of this block deal that's taking place. We were already given to understand there could be an over 7,000 odd crore rupee of a block deal. Indigo co-founder Rakesh Kangwal and Chinkrupu Trust could sell 3.1% stake of 7,027 odd crore rupees at a 4% discount, and that's what the price is reflecting right now. So you see a 4% downtrend on the Nifty. The trade value right now we are told is 5,177 crores. Let's see whether there is also another follow-up block deal that takes place here. But right now 2.3% equity has exchanged hands on Indigo. So keep that in your mind. That's the key reason why Indigo is showing you that knee-jerk reaction. Advances still on the positive side on the Nifty. The breadth is positive. 893 advances to about 1200 decline. So it's rather towards the negative side, in fact. Let me look at the Nifty laggards. Power Grid is lower in trade. HCL Tech, HDFC Bank, over a percent lower. These are the key stocks that are starting on the back foot right now. But I think we should clearly pick up all of those sectors that are likely to see the immediate knee-jerk reaction on the tariff blow. Let's pull up all the textile stocks. Let's pull up Gokaldas Exports, Vardhaman Textile, KPR Mill, Arvind Limited, Raymond. Let's pull up all of these stocks higher to see how the reaction is being seen on that front as well. Let's also pull up even the fertilizer and chemical names as well. So I think all the export oriented textile names are down. Gokaldas Exports starting over a percent cut. Wellspun Living 1.5% down, 1.8% of a fall for Arvind Limited. Remember, there is also a cotton import duty exemption till December 3rd, that 31st that we are given to understand, but that may be somehow limiting the impact on that front as well. Let me also pull up some of the other stocks. So right now, if you look at the Nifty, 24,600 has been breached on the lower end, viewers. So we are slipping lower, 135 odd levels. Kush Kodasara is now joining in on the program to share with us his views on the markets. Kush, warm welcome. Good morning to you. Tough day for the markets. One, we have to face the blow of 50% tariffs since yesterday the markets were shut. And we have to yet decipher which are the sectors that are hit the hardest. First, view on the Nifty first. We've slipped below 24,600. What would you say?
Good morning, Sakshi. Definitely, I mean, last time we met before 15 days, we had, marked the level 25250 as a strong
Yeah.
resistance. Still, that level could not be bridged on the upside even after, announcement of GST. So I think, there is slowdown in economy, which we have been discussing since many months. So whether, tariff is just, just a reason to fall. But I think, slowdown in crucial markets like real estate, somewhat like auto sector in four wheelers. I think this is showing up. If you look at NBFCs, micro financing like durable goods financing has slowed down. So I think this is the effect of slowdown in economy. Definitely now 24,350, which is previous low, is a crucial support. But once we break that, we open for 22,800.
Okay, what about the Nifty Bank? Remember, it's the monthly expiry, so we have to look at both the indices very closely. How would you look at the Nifty Bank to trade today?
Definitely today already it's opening down. So I think if you're a short-term trader, if you bought any puts for the August expiry or something, just book out right now and maybe shift it to September. Maybe there would be a bounce back. I'm not sure, but yes, book profits on Bank Nifty because it has been underperforming Nifty by approximately 1.5%. If I see the divergence ratio as of now on my charts. It has been underperforming 1.5% to Nifty in last 2 weeks. So I think we should book profits on Bank Nifty for once. Don't go long. Maybe buy puts for the September series.
Okay, fair point. I hope this has also given you some understanding there. Kush, what do we do with the textile stocks today? They are showing us some weakness. Would you stay away or would you, in fact, look at buying this dip?
I think I will start buying the dip for long term, definitely on the textile stocks, because actually one thing is for sure. I mean, US cannot afford manufacturing, make in America. I mean, the labor is cheaper in Asia and Southeast Asia, of course. So maybe deal. It will take time to get signed or come to a common point. But I think this sector is a good sector to invest for long term because consumer, if you look at, we have one of the highest populations, so consumption is also great over here, so no one can ignore India on a textile map. So start buying quality stocks for long term. Next 10 is for 10 years are going to be good because people are also shifting from unorganized brand to organized brand. Yeah, if you look at tier 2 tier 3 cities, so definitely something like Arvind Lifestyle, who has a good multinational brands contracts in India, should be in your portfolio.
Okay, got that. Let me also bring up some of the other sectors. What about fertilizers and chemicals, Kush? That space is also going to be some knee-jerk reaction of the tariff blow again because we do export a lot of our fertilizers and chemicals as well. This space has actually rather been very volatile in the Indian markets too. But now with this fresh blow coming in, what would your fresh strategy be here?
Definitely, for short term, maybe we may see a blow on this segment, but because we have seen a good momentum built up in last 3 months, so technically also profit booking is expected. So something like Chambal fertilizer, fact, these all are looking good, but still wait for 8 to 10% correction to buy for long term. These stocks are not for short term trading; they are very low beta. So Chambal fertilizer around 520 is my target, where we will review and start buying. So avoid right as of now, but yes, definitely wait for some more downside levels to start accumulating.
Okay, let's also discuss autos and auto ancillary spaces. Some of these stocks are actually hovering higher. From last couple of weeks, we've been seeing renewed focus on two-wheelers, on four-wheelers again. On the one hand, we are again looking forward to understanding what could be the impact on some auto exports and some auto component exports because of these tariffs. But at the other hand, GST rationalization is also likely to benefit a large part of auto industry. ICE vehicles, for instance, and we should also be looking at two-wheelers, for instance. All of these used to be taxed at 28%. Now, what we are given to understand from our sources on Business Today television is that the fresh rates could come down to 18%. Now, in case that benefit is passed on to the consumer with lower rates, a lot of brokerage houses have also come out with their expectation 8 to 10% kind of price reduction is what they expect on two-wheelers and on small cars specifically. How would you look at this auto space to be played in the festive season, which is otherwise also a tailwind season for this space?
I think this time I don't think there will be a good boost up on this auto sector. Maybe the necessary, consumers who really need it will buy it. I don't think a luxury buy or extra buy would be happening this festive season because the layoff in IT sector have a ripple effect on many small scale industries also. And I think that is the reason why people are cautious, or several people are cautious for buying or spending more money. So I don't think auto sector would see much of a jump. Year on year growth would be growth rate would be diminishing. So I am not positive in near short term. Yes, maybe something like hotel industry may see some jump because there is where people have realized one thing after COVID, just in vacations, just go out and spend some time with family. So rather than auto sector for this festive season, I'm focusing on travel and tourism segment.
Okay, got that. So within tourism, are you looking at the hotel stocks? Are you looking at aviation? Or are you looking at more tour operator stocks? How are you looking to play this one?
So yes, definitely lemon tree is in my watch list and even the recommended stock for long term buying. So lemon tree is a stock which should you focus on because this is a segment actually where lemon tree is focusing on business travelers more. I mean, if you look at lemon tree's footprints, they are more into cities where there is industrial focus. And now they are launching Orica brand, which is a luxury brand. So lemon tree is something like Tata Motors of auto. I mean, it is present in all segment of hotels, trying to be present. So lemon tree with a stop loss of 160, you should buy for short term. Target 185 post Diwali. But if you're a long term investor, 150 is your stop loss on lemon tree. Target is 350 plus in next 2 years. And for luxury brand, purely you can buy ITC hotels.
Okay, got that. So there you have it. Within the hotel space, a lot of opportunities there. Now, viewers, we have over a 600, 650 kind of a fall on the Sensex right now. You're also looking at about a 500-point drop on the Nifty Bank, which is slipped below the 54,000 mark. On the Nifty, you're already seeing near 180 point of a cut. We've slipped sharply below the 24,550 mark also on the Nifty. So the weakness is escalating, at least for now. Let's also look at the key stocks that are contributing the most to this weakness. Among the large caps, you have banking names like HDFC and ICICI Bank. Among the other heavyweights, you have Reliance Industries that's contributing 24 points to the negative end. Even IT stocks like TCS, HCL Tech are showing us some weakness, at least at this point in time. Let me get you to talk about some of these stocks and key sectors as well. Kush, first, Reliance Industries under pressure for some days now, but tomorrow is going to be an important day. It's going to be the AGM that everybody will be watching out for. Of course, like always, hopes rise on any indications on any IPOs that could come in from Reliance Industries conglomerate fold. Whether or not it will come tomorrow, we would not be able to say, and all eyes will have to be on the AGM to find that out. But how would you look at the stock price performance ahead of AGM, and what would your suggestion be here?
So, as a disclosure, my family is holding the stock since long term. I mean, since the IPO of Reliance. But for short term, I believe stock price is on the way towards the south. I mean, we are going to witness some profit booking. I think we are about to break previous lows. So before 2 weeks, we had made a low in the start of August around 1365. So we are approaching that level. So I am little bit cautious on the stock for short term. I think if we break 1360, we may see 1250 again. So that is 1250 is the level technically where I will start accumulating again for the long term. So avoid Reliance Industries for short term for sure.
Okay, what about the banking heavyweights, HDFC, ICICI Bank? Why I want to ask you about these particular stocks is because, when the market started to recover in trade, it was these two banking stocks that largely led to a recovery in Nifty Bank and also contributed to the Nifty at large extent. The attempt to go back above 25,000 and from the lows that we were seeing for many months, about 8 months of consolidation. From that kind of a, consolidative phase, the recovery started on the back of these banking stocks. What is the fresh view, especially on HDFC Bank, which is now at a fresh level that we are seeing after the bonus split has come in to focus. So now in 3 digits. So for those who are looking afresh at ICICI Bank and HDFC, what would you say?
Just wait and watch. Actually, I won't suggest going long at this level on ICICI Bank or maybe HDFC Bank. Reason is why we as a technical analyst, after COVID, I mean really most of us just watch on daily and weekly charts, but look at the actions on monthly chart. I mean we are closing down on August month in next two sessions, including today. So ICICI Bank is trading almost at last 4 months low. I mean if we break 1400. Last time we saw below 1400 ICICI Bank was in April. So imagine, the weakness we are facing in the banking stocks. So completely avoid buying fresh on heavyweights on private sector bank. Definitely they are good for long term, but I believe around 1100 to 1200 is on the card for ICICI Bank, if not lower.
Okay, got that. 9:30, first 15 minute of a candle is formed, and we have also further slipped lower into trade. What would that lead you to do at this point in time? Any fresh strategies that you'd like to devise?
Definitely, 2 weeks back, maybe everyone can check, BTTV's handle we gave Bank Nifty as a short. So, that was around 57,000. Book profit on that short Nifty as of now. Stop loss 24,850. And if you can wait for 2 weeks, we may see 23,500.
Okay, fair point. Let me just go back to the markets to see if there are any fresh stocks that we could look at. Meanwhile, viewers, all the sectors have also slipped into the red. The India VIX is sharply higher at 6% up, 12.9 odd levels that can be seen. So a very, sharp spike that you can actually see on India VIX, at least for now, in the markets, that's leading to all the sectors also come under severe pressure. Real estate is the top losing sector, 1.5% lower. IT comes next with 1.3% losses. Mid caps and small caps sharply underperforming the benchmarks, over 1.2, 1.3% of losses there. Look at even the pharma, financial services, banking space, that's also come down under a heavy pressure, at least for now. Let's also look at some of the stocks that we can mark out for all our viewers. Eternal is definitely doing well at 320 odd levels. Hero, Eicher are up. Asian Paints is now pulling up pace as far as the Nifty movers are concerned. Let me bring in the Nifty 500 names as well. LG Rubber is up another 17%. This stock has been in focus for the last couple of sessions. Look at even SMS Pharma. Look at names like even Bafna Pharmaceuticals, that's higher in trade. What else is buzzing? You have names like Omkar Specialty Chemicals, that's up in trade, but far and few between names that are actually buzzing. But a large part of the markets that still are under pressure. Any key stocks within the Nifty 500 broader markets that catch your attention?
For buying, Sakshi, nothing.
Yeah.
No, no stocks.
No
Avoid.
stocks, only on the selling side,
Because
Kush.
our viewers are very aggressive, and if we recommend the stock, they will buy for short term. But I think
Yeah.
this is not the right time to trade on a short term. This is the right time for a long term investors. I mean, those who felt that we have missed the rally, this is the right time to start getting greedy for long term investment.
Okay, got that. So there you have it. That's the view that has been shared by Kush, that at this point in time, no stocks for buying is what he clearly believes in, at least at this point in time. Okay, any safer zones, Kush, which are tariff proof sectors that you could probably look at for our viewers?
So definitely one sector, which I would again say don't get aggressive for short term. But yes, if you want to buy something, if most of the traders are long only traders. Focus on FMG stocks. I mean, FMG sector has underperformed Nifty since like quite some time, almost 2 years. And that is a sector which is not much affected from tariff, because we our Indian consumption is domestic consumption is more than export. So something like Tata Consumer and Britannia is on my radar. So if you're want to play a safe bet, maybe Britannia and Tata Consumer, you can buy for next 1 and 1.5 months, because we are also going to have a festive months. So Britannia is already up. So 5,600 it can be a stop loss, and target can be 6,200. Tata Consumer again, because of Starbucks and FMCG sector play. Tata Consumer is looking good. Stop loss at 1,040. Target 1,200 in 2 months. And one stock which you already mentioned, Eternal. I mean, now Eternal is something like mobile data. It's not a luxury anymore. Their services are part of our daily routine. So Eternal, good buy 300. Again, stop loss is 300. Targets around 380. So these three stocks for 2 months you can definitely buy.
Okay, so long-term investors can actually take the benefits there. Some tariff-proof sectors and stocks that you could definitely be looking at least at this point in time. We are now 200 points lower in trade, viewers, 24,511 on the Nifty. Let's see how this goes on to trade as well. Let me also ask you, Kush, to help us understand on some of these paint related stocks like Asian Paints. It's been such a long time of underperformance for such stocks. But again, look at the upcoming festive season. Could that augur well yet again for these otherwise laggard performers like Asian Paints, currently at 24.98?
So definitely, you have rightly pointed out, paint segment is sector which is generally booms during before Diwali, because generally people get their house repainted. But I think Asian Paint has lose that market share. I think many new entrants, big corporate house like Birla Opus, JSW, even Astral Paints, they are giving good offers to painters at ground level than Asian Paints. So I don't think Asian Paints is a stock you should look out for. Overall sector, I'm positive, definitely, but not Asian Paints.
Okay, fair point. I hope this is also something that everybody can definitely keep an eye out on as well. Let me ask you on some of the other key sectors that are drawing our attention. What about the oil and gas space, commodity space, metal space? What's your thought process there?
I think oil and gas sector definitely looking weak. I mean, Reliance is leading the sector already. We are
Yeah.
witnessing last 3 weeks low. I have Sakshi. None of the sector is looking good for me right now. Until we see some base formation, we can't confidently say a buy. But right now, everything is looking weak.
Okay, fair point. Let me also just ask you on some of the other sectors. What about real estate? Why is that coming under severe pressure? And what is your fresh strategy there? The news flows were pretty positive across the board. Many of the companies have been on an acquisition spree of the land, launching newer projects as well. What's auguring currently in the real estate basket?
So, real estate sector, what I have done some ground level survey in few cities like Mumbai, Ahmedabad, and tier two cities like Nasik, Nagpur, and Rajkot. I did in last 1 month. Uh, Came in contact with many real estate players. So actually, the issue is there is a sale deal happening in the luxury segment, but the focus is a higher mid segment, which is consumer are morely salaried people, and layoff and no hike in salary is pinching them, and so fresh buying of properties in affordable segment, higher affordable segment in 2 bhk 3 bhk is not happening as it was happening in 2022-23. So I think there is a pretty much slowdown. Even there are many real estate players in tier 2 tier 3 cities who are in the cash crunch. They are not officially out, but yes, we can feel that commercial sales is going down because work from home has now been adopted vigorously in many MNCs and many even small scale companies because it's cost effective. So definitely, I think the real estate segment is going to see a big time sideways momentum. So stay with the leaders. My choice is still Brigade Enterprise because they have a good rental income also in Bangalore and uh, out of Bangalore. So avoid buying fresh in the real estate sector for state.
Okay, got that. So that's the view on the real estate story. Also, viewers keep that in mind. What about pharma? That's also one of the defensive players, and at least for now, we don't have a tariff yet. In place for the pharma space. Remember that pharma also exports quite a bit to the US, but because the sector is so far exempt from the major 50% blow on the tariffs on some of the other sectors, this space is still to be looked at in a positive realm, especially because a large part of our generics goes to the US that makes even pharma drugs in the US for US citizens quite affordable. What would you say here? Even though there have been constant updates from Donald Trump saying that we are going to be coming up with fresh set of guidelines on pharma, and they want to bring in, like you pointed out, it's going to be difficult, but they definitely want to bring manufacturing of pharma to their country.
Definitely, but that's not going to happen as of now. Also, there are many acquisitions going on in small and medium enterprise API. So, pharma sector, I am a little bit cautious. So, yes, I'm buying pharma stocks through mutual. So avoid pharma stocks direct investment. Pharma's index is weakening right now, so I'm not buying stocks currently directly. But yes, definitely I have recommended my clients to raise their SIP in pharma thematic fund for next 6 months.
Okay, fair point. That's the clear view there. Let me also ask you on, some of the other consumption-oriented names. You did talk about how FMCG should be looked at in a positive realm. What about consumer durables? Do you think some of the benefit could also come in here on the household consumer durable names?
Yes, definitely, but I think still it will take some time. Actually, maybe after December we'll focus on that segment. As of now, I am just keeping a watch on them. I'm not buying or recommending any buy.
Okay, fair point. Let me also bring up some of the other spaces that we can discuss with you. We were talking about the real estate space, but what about the cement space? This has been a clear focus area for all the analysts, especially again, we have a GST benefit that could come in from 28% to 18% for the cement spaces. Already in this year so far, it was the South-based cement companies that were benefited from the price hikes that they had done. What about the entire sector there, and any top choice that you could share?
Definitely, my top choice has always been Ambuja. As a disclosure, my family is holding Ambuja stock. But why? Because actually, I think slow and steadily, cement sector going to have only giant players because there is a lot of acquisition going on by major cement players. So Ambuja Cement is my pick, but at current levels, I think we may see some profit booking. Ambuja Cement around 520 is a good level to enter. Overall, yes, definitely GST is going to get passed on cement sector, but I think
Okay.
on the cement we may see some more down.
Okay. Kush, what about the absolute domestic themes? Look at railways, for instance, and look at defense, for instance. How would you look at these two stories?
Definitely, I think defense is something we are showcasing in the world that make in India products are going to be the new products in demand. But we have already seen a good rally, so waiting for some more corrections to accumulate stocks like HL, BEL. But railway stocks, I don't think we are going to witness any good rally in short term. Yes, they are generally favorite before the budget, but I don't think we are going to see any major announcement because still there are many pending projects like bullet train and stuff. So I don't think new investments are going to come in this segment. So avoid railway sector completely. Maybe IRFC is something which you can stay focused on, but nothing on manufacturing.
Okay, fair point. Thanks a lot then, Kush, for being with us on the program and, helping us with all your insight on various sectors that you're looking at, and of course, a strategy on both the Nifty and the Nifty Bank on the expiry session as well. We'll get you soon, to talk about fresh levels yet and again on the other edition as well. So thank you so much. Hope you have a great day ahead. Let's now kickstart, viewers, our discussion on what could be the impact on the economy at large because of these fresh 50% tariffs that we've been hit with. Also, to understand what could be the implication on our GDP growth going forward. Remember, tomorrow is when we also get the quarterly update on GDP growth as well. So all of this will be discussed now. Two special experts who will be joining in now. First up, we have Sakshi Batra, Principal Economist at HDFC Bank, now joining in. And we also have with us Aditi Nair, Chief Economist at ICRA. Warm welcome to both of you. Good morning. Thank you so much for taking the time out for this very important discussion. Good to be having both of you with us to decode for us what will be the on-ground impact of these tariffs and what do we expect on the GDP front as well. Kickstarting with you, Sakshi, help us understand, of course, we've been looking at so many sectors that have higher exposure to the exports in the US that could face the first set of the blow. What is the clear impact on the GDP growth that you expect of this 50% tariffs if these have to stay till the end of FY26?
Right. Good morning. Thank you for having me on the show. When we are kind of trying to understand the impact on GDP growth, our estimate is that these 50% tariffs, if they kind of continue, the downward impact on GDP growth could be close to 40 basis points from our baseline, which is 6.3% GDP growth for this year. Clearly, we know that a part of our exports to the US are exempted from these tariffs as of now. So, large sectors like pharmaceuticals, semiconductors, etc. But at the same time, there are a number of very, very labor intensive sectors that can have, that are like, gems and jewelry, textiles, that will have, also second round effects play out, both in terms of, their exports to the US, but also in terms of their implications for the labor market. Kind of taking these factors into account, that is a sort of downside risk we see. But I think at the same time, one has to appreciate that there are also certain offsets that are playing out for GDP growth for this current fiscal year including, the traction that we are seeing in the rural economy, the positive impact that might come through because of the GST rate tax rationalization that the government has announced, and of course the impact of the already delivered interest rate cuts by the RBI. That's my assessment on the growth front. I think these are certain things that we look out for.
Sure. So 40 basis points kind of an impact on the overall GDP growth if these tariffs are to sustain till FY26. Let me come across to Aditi as well. Help us understand, Aditi, what's your base case for FY26 GDP growth rate, and what kind of an impact are you penciling in because of these tariffs so far, or are you just looking forward to some finalization on this front to come in, because we are not yet ruling out any further negotiations as of yet?
Yeah, thank you so much, and thanks for having me on the show. So we are basically now looking at FY26 GDP growth coming in at around 6%, and this is what we had taken, the baseline projection we had made before the penalties kicked in, but it was also pre the GST announcement. So as of now, we are holding on to 6% because there is some amount of lack of clarity on both of these fronts, whether further negotiations will help to offset the penalties, do away with the penalties, and also really when will the GST rationalization come into play and in what form. So Sakshi's already spoken a lot about the tariff impact. Let me talk a little bit more about how we're seeing the GST impact possibly playing out. So for the second half of this quarter that is currently underway, there may be some amount of delay in discretionary purchases on the presumption that they will become cheaper, presumably after Diwali. So there are some items that are bought in anticipation of the festive season. Those will be bought before the festive season. But something that's discretionary, where the timing is not really tied to the festive season, that is something that can get deferred to after the GST rationalization actually happens. So there could be a little bit of a blip. We are projecting the Q1 GDP growth number, which we'll get tomorrow, as you said, at 6.7%. And from there, I think 7. The GDP growth at 6.7%.
Okay, this is higher than the MPC estimate.
Yes, it is.
Okay.
Q2 might show a downward blip. If the GST rationalization happens by Diwali, then Q3 could see a little bit of a pickup, and then Q4 could see another downtrend. So we are anticipating a bumpy, volatile sort of momentum on the GDP growth front this year. Now, why is the Q1 GDP growth as high as 6.7%? There are two major reasons for that. One, we've seen a lot of upfronting of capital expenditure and a very high growth on a low election curtailed base for both Government of India and for the state governments in their capex in Q1. And also, we did see some amount of upfronting of non-oil exports to some geographies, particularly to the US. So that again has pushed up the Q1 GDP growth number. And both of these, the positive impact of both of these will sort of taper off as the year goes forward. So that's something that will pull down the headline GDP growth numbers. And the average, of course, for the full year being 6% does mean that at least a couple of quarters are likely to be sub 6 and, maybe in the range of 5.5 to 6%.
Okay, got that. Bringing in Sakshi again into the conversation, how much of do you think what you mentioned already, the positive impacts of a normal monsoon, pickup in the rural economy, GST rationalization, how much of all of this can cushion the impact of the 50% tariffs that we are hit with?
Right. For this year, look, the rural story, I think, will continue throughout this year. We are coming on the base of very good monsoons and agriculture production last year, and now this second year, right? So the momentum on the rural side, I think, will be pretty strong. And I think that is one of the biggest supports to overall GDP growth that we'll see. On the GST rationalization bit, I think that we are penciling in about a positive impulse of, 20 basis points that might come through. And, most of it, we expect that to play out in the third and the fourth quarter of this year. So, I agree with Aditi that the second quarter could actually see some slowdown or moderation as households choose to kind of delay some of their discretionary spending until the GST rates are announced. Look, I think at the aggregate level, I would say that, the rural economy, momentum, as well as this impulse from the GST, rate cuts, while it does offer, some amount of cushion, I don't think that this in itself would be enough to completely offset the drag that we will see from the tariff impact. Moreover, I think we are yet to see a slowdown just because the U.S. economy is also expected to slow down. So I think that impact both on goods and services is also something that is not being witnessed yet. And I think by the end of this year, that is an additional drag beyond the tariff play that could also weigh. And that is exactly why, on a net basis, we are looking at a downside risk to our baseline forecast, despite the offsets that, we are discussing.
Okay. Aditi, coming back to you, when it comes to some of the aspects that you mentioned, I want to understand on the private capex that's already been, slowing for such a long time. And now with these additional uncertainties, do you further see a delay in private capex is one. Secondly, because of these tariffs that are hitting labor intensive sectors, do you expect some kind of subsidy, some aid, financial assistance from the government to come in? What is that likely to have an overall impact? Plus we have GST rationalization that's again going to cost the government in some or the other bit. So how are you looking at these aspects?
So I'll start with the private capex. Certainly, this is something where we expect a delay. And in fact, we started the year with a 6.5% growth forecast for the Indian economy, and we've lowered it in two rounds to 6% now. And not just exports, but the direct impact is going to be on private capex. In this kind of uncertainty, we really cannot expect private capex to be very gung-ho in sectors that either have a significant export contribution, especially in the US, or sectors where import substitution is relatively easy, where there are relatively fewer barriers to import substitution. So, I think that's something that's a given. And the fact that we did have the headline capex growth being quite strong, particularly in Q1, will help to start with. That impact will start tapering off. Now, on the labor-intensive sectors, certainly this is negative, the kind of stress which is there, the uncertainty related to the tariffs. And perhaps that is something that will start showing up in the urban consumer confidence surveys going forward from the next round. We might start to see the impact of that seeping in. And GST rationalization will help those households that are unaffected relatively, rural and urban. But the households that are affected by the tariff-related and other uncertainty, definitely in those sectors, the overall consumer confidence will take a hit. So it's likely to be a very uneven year once again for consumption. Rural relatively insulated, and urban, unevenness across the household demographics depending on which sector they're deriving their primary income and employment from. On the fiscal side, now I'll give you, a sort of pre-15th of August, or rather maybe let me put it this way, 1st of August assessment that we would have had on the fiscal space. So at that point, we would have thought that there is about a buffer of 50,000 crore coming in, particularly from higher non-tax revenues that can help to offset either any dip in tax revenues or push up expenditure. Now, the dip in tax revenues could have been from direct taxes, which haven't done too well in the first few months, or from any revenue loss related to GST, as has now been, the GST rationalization has now been announced, but we're not quite clear on the final design. And therefore, we're not quite certain on what kind of revenue loss implications that has. Or it could have been used for higher expenditure, either on capital, on the capital side, or to give some sort of support to the export focused sectors.
Right. One question that I have to ask both of you to help me decode is that what we are looking at as the the relationship between US and India because of these ongoing trade tariff war or talks kind of a situation. Has it dropped to an all-time low? What does that lead us to do? I mean, for now, Sakshi, maybe you can begin by helping us understand. While India is not a very big partner or a trading partner with the US is our largest trade partner. So what are the options available with us, at least at this point in time, to be able to, yes, like Prime Minister Narendra Modi said, we have to safeguard our domestic industries, but yet at the same time, we cannot just put an oversight on our largest trading partner and see, how much longer, how long can we actually sustain with this kind of a tariff?
Well, at 50%, of course, we realize that, these are extremely prohibitive, tariffs. It's almost like a trade ban that, it essentially implies that. But at the same time, I don't think that, bilateral talks with the US are, we should see this as a signal that we will not have further developments in terms of bilateral talks with the US. I think that is going to continue going forward. And, I would expect that over a period of time, as India tries to kind of iron out certain, details with the US, hopefully over the coming months, there will be some sort of a trade deal, that we are able to strike with the US. At the same time, as you mentioned, I think that this is a good opportunity for India to also start looking at, ways to kind of support domestic manufacturing further. And in terms of our export strategy, look at other markets where, there is scope for diversification, right, in a number of products. So, for instance, gems and jewelry, while US is our largest trading, partner in terms of that sector, I think that, we do have considerable exports also going to, the Middle East, UAE, parts of Europe, etc. So there is scope for us, in certain segments to start looking at other markets, in terms of de-risking our export basket, and in general looking at, how we can grow exports over the medium term. So I think it has to be, from my perspective, I would see this as, the trade policy in general going forward being dual in nature, where we are looking at diversification, but at the same time working towards some sort of trade deal, hopefully over the coming months with the US.
Absolutely. Aditi, coming to you with the same question, but also with the fact that, the statements coming out from the US government is startling to say the least. I mean, advisor of Donald Trump, Mr. Peter Navarro, we've heard from him how he's talked about the Russia-Ukraine conflict as Modi war. He's slamming India's trade negotiations as arrogant. He's insisting on the road to peace running through New Delhi. And he's insistent that the day we stop buying Russian oil, we could be back to a 25% tariff. How are you looking at all of these statements? Because, so far we were understanding the trade talks have to be either on the basis of the relationship that we share or on an equal footing on where their industries benefit and it's a win-win for both the countries. But now it's coming from a third angle that, you are benefiting from, an enemy and therefore we are going to be penalizing you. So how are you looking at that?
Look, I think nobody really expected a situation like this where statements such as these were being bandied about on a daily basis. I think a lot of it is posturing and negotiation. And once the dust settles on this entire episode, it's going to be a great case study for game theory.
Absolutely. Okay, so in the end, I'll just take one view from both of you. Help us understand when it comes to what do we expect? What are the ways ahead that you see the Indian economy going forward to? And what is your key takeaway from the current scenario that all of us should be, looking forward to as a key trigger for the economy? Sakshi, starting with you.
Well, in the near term, key triggers that I would be actually looking for is the government's response and what sort of fiscal support they come out with in terms of hard policies, for exporters, particularly MSME exporters or sectors that are, expected to be hit by these tariffs. So I think that is something that I would closely kind of watch out for in terms of, just general macroeconomic impact or assessment even for this year.
Okay, Aditi, to you as well. We do expect a shortfall in our exports from over $80 billion to under $50 billion now. How do we make up for this?
So, a couple of things, in terms of triggers, I think one of the close things that I'm going to be watching out for is whether the government of India does give a second tranche of tax devolution over and above the normal one in either September or October. That would suggest that they are more confident on the tax side, and will also help us to, in conjunction with the borrowing program for H2, get a better handle on how the fisc might turn out to look. And how do we make up for the lost exports? It's going to be hard in the near term, but over the medium term, obviously, we need to have a strategy for diversification, just as Sakshi said. Beyond that, in terms of the current account deficit, our baseline expectation for this year was as low as 0.6% of GDP. But with the 50% tariffs, it could go up to about 1.3% of GDP, which is still very low by what economists like us are used to, thinking that we start to get alarmed at 2.5, 3% of GDP. So even if it goes to 1.3% of GDP, I think broadly it should be okay. Might be a little bit of stress on the financing front, and in that situation, we would see a drawdown in reserves. But so far it's not looking like it's going to be a disaster on the current account deficit front.
Any key benefit of the sovereign ratings upgrades that we are looking at that we should be hoping for, Aditi?
I'll leave that to Sakshi to answer. As you know, my parent is Moody's, so I'll have to stay mum on this one.
Yes, Sakshi.
Look, from a medium-term perspective, of course, the sovereign rating upgrade bodes well for India, right? I think that we did see little reaction from the market. I mean, very short-lived reaction for now, because there are so many other things that are happening and the market is obsessing over. But if you look at the experience of other emerging markets, and what has happened with them when you do see a sovereign rating upgrade, I think over the medium term, it does have positive spillovers for things like FDI, of course, FII, investments. So, I think it is a positive. But for now, there is too much noise for us to kind of, talk about or reap those positives, in the near term.
All right. Well, this conversation could have actually gone on. There are so many aspects that we have to discuss, but we leave it for some other conversation as well. We are out of time on our morning edition. Thank you so much, Aditi, and thank you so much, Sakshi, for sharing with us all those insights. We'll, of course, look at what tomorrow Aditi has pointed out. Her expectation is 6.7% on Q1 GDP. Let's see how that augurs. And, of course, we'll be speaking to both Sakshi and Aditi following those numbers are coming out as well. Thank you so much for being with us.
Thank you.
All right, viewers, let's start wrapping up the morning trading action on market today. Then 120 points lower in trade, but we've improved from the day's low, and that could give us some heart. Look at 24,595, inching back closer to 24,600 odd mark. Sectorally, the action still remains weak on a large part of sectors. Consumer durables are trying to pull up in trade. Oil and gas is also making some attempts. On the Nifty, you have Asian Paints, Hero, Eternal, Adani Enterprises as some of the stocks that are shining. You can also look at the F&O action. Kalyan Jewellers is up. Granules is higher. Uno Minda is up in trade. Some of those stocks are also moving up. So let's see how this really pans out. But the good part is it's not like a washout morning session right after that 50% blow that we've got. Slowly and gradually, we are trying to find our foot. Let's see how this ends with, because it's going to be the expiry session that all of you are going to be closely looking at. So stay tuned with us on to Business Today Television. Market coverage continues on the other side. In case you have questions about the stocks in your portfolio, ask them away on daily calls at 12 noon.
The die has been cast with Donald Trump erecting an unprecedented tariff wall for India's export.